Hi, good afternoon. I'm Andre Strydom from PASA. I'm here to introduce the speakers. So this session will explore the risks of CBDC and unpacking the current realities. So to lead this session, we have three speakers that I'll call to the stage. The first is Chris Becker, who is the Managing Executive of Enterprise Banking at Time Bank. We have Toby van der Spy, who is the co-founder and CEO of Block Markets Africa. And then also Comfort Pelani from the Reserve Bank, the Senior FinTech Analyst. Again, to the delegates, if you have any questions that you would like to pose to the panel, you please use the Slido app. So if you have not yet downloaded the app, the QR code is displaying on the screen there. So please make use of the opportunity to download the app. And then without any further ado, over to the panel. Thank you.
Good afternoon, everybody. Thanks for turning out to listen to our session on CBDCs, the current state of play on CBDCs. I think with what's going on in terms of the crypto space generally, I'm actually surprised at the number of people here. Thank you for attending. As introduced, I'm Chris Becker. I'm at Time Bank. I'm the Managing Executive of Enterprise Payments. And really looking forward to the conversation today. I'm joined by Toby van der Spy, who's co-founder of Block Markets Africa. I think as most of you will be aware, and if not, Toby's been at the coalface of a lot of the innovation and experimentation between banks and industry and the SARB around stablecoin and CBDC initiatives in the likes of Project Corca. So welcome, Toby. Nice to have you on this panel. And then Comfort Pelani, who's a senior fintech analyst at the South African Reserve Bank. And before that role, spent time at Genesis Analytics for many years analyzing digital currencies and financial inclusion in Eastern African markets. So thanks, Comfort.
Cheers.
Nice to have you here. So this topic of CBDCs is an interesting one. It's been interesting for me because I've never been quite sure and clear on the benefits of this CBDC concept. Central bank money is already a digital construct. It's already digital. Now we've got this technology called the blockchain, which was first kind of applied in terms of a use case with Bitcoin. And the point of Bitcoin is to not have that trusted technology stack that Chris Hamilton was speaking to previously. Now what we've done is we've taken this money that doesn't require, or this technology that enables the money to be created and for payments of value to flow over the internet without the need of a central intermediary. And we're trying to strip a component of it out to bring about this idea of a CBDC. I think where we want to sort of head with this conversation is we want to start off by discussing this initial vision of CBDCs. What's the idea? Why are we doing this? But secondly, we want to speak to how this vision's perhaps evolved. So as we've put our hands on this tool as industry, what are we actually finding it useful for? How's the idea of what this thing's going to be useful for evolved? And I guess then lastly, we're going to leave us some parting thoughts on where do we think this is all going. So very excited, you guys right in the mix. I think I want to start with Comfort. So on this vision of CBDCs, I think everybody, certainly in South Africa, looks very much to the South African Reserve Bank for guidance.
Yeah.
We're dealing with this new technology. It does things differently to how we've done it in the past. But now we're putting it into a construct where we're kind of doing the same thing. I know the SARB has been thinking about how to supplement physical cash through the use of a CBDC. And obviously there was you guys have published a paper and you've done Project Corca 1 and Project Corca 2. Mm-hmm. What is the SARB's view on this? How are you guys thinking about it? What do you think is the vision and the benefits of a CBDC?
Awesome. Thanks very much, Chris, and good afternoon to everyone again. So, I'll give a bit of a long-winded answer because there's a few things I wanted to touch on. But maybe to begin with, I think it's useful to give a picture of where all of these developments come from. So, there were a few developments in the last few years to a decade that have propelled money and payment systems at the top of the global policy agenda. So, the first was this rise of privately issued digital currencies like Bitcoin, etc. Chris Hamilton spoke about the entrance of big technology firms into financial services, the idea of these wallets and massive global wallets that can move money across various jurisdictions, the introduction of stablecoins, and I'm sure many of you will remember the debates around global stablecoins when Facebook was looking to introduce Libra. And the fourth, of course, is increasing digitization. So the increased adoption of digital solution, especially accelerated by the COVID-19 pandemic. So amidst all of these developments, there were emerging questions for us, especially within the central banking community. So the first is, what is the role of a central bank and the role of public money within this increasing digitization, within this privately issued digital currency construct? And what is the value of the central bank still providing a public good that is, public money? There's also debates around monetary sovereignty, right? So if there's a rise in a larger base of consumers adopting these privately issued digital currency, are there certain concerns or risks for central banks in the idea that you might lose monetary sovereignty? The third is also around monetary systems and financial stability, right? So when you have all these multiple tokens or privately issued coins, you might have an instance where there are multiple closed-loop payment systems that might lead to some fragmentation, whereas central banks have this policy agenda to promote efficiency and stability within the payment system. And then lastly was whether or not the idea of a digitally issued currency that is backed by the central bank could promote certain policy objectives. So if you think about things like financial inclusion, so the adoption of a digital currency versus cash might provide you with data, for example, and further then add on other products. Or could it also support things like making payments faster, cheaper, safer, and more convenient? So in 2021, the South African Reserve Bank launched a number of initiatives to explore CBDC across multiple perspectives. So the first was a study we commissioned to practically investigate the feasibility, appropriateness, and desirability of a general purpose CBDC. And that would be used for retail payments, complementary to cash, as Chris has mentioned. So the study took on a two-pronged approach. Firstly was a desk-based research to see what have we learned about retail CBDC from other jurisdictions, but also then we practically partnered with two solutions partners that developed a CBDC within a two-tiered distribution model. So that is partnering with intermediaries to distribute that CBDC. On the wholesale CBDC front, Chris also mentioned Project Cockatoo, which is our flagship distributed ledger technology in financial markets project, where we issued, cleared, and settled SOB debentures on DLT using a wholesale CBDC, that is a currency that is backed by the central bank, and a wholesale token, which is similar to basically a stable coin issued by the industry. And then it's also important to remember that we operate within a global construct. So the money moves around and, international trade and international transactions are very important for the economy. So it's important to explore how CBDC could potentially address some of the challenges around cross-border payments. So things such as cost, transparency, speed, etc. So although I'm not yet in a position to share some of the learnings from the retail study, the SOB has not yet decided on whether or not we will proceed with implementing a CBDC. But I think it's useful to share some learnings as far as what have we got from a lot of this work that we've been doing. So although we are yet to decide whether a CBDC is the right thing for South Africa, there's certainly some things such as it being possible to it being a potential tool for addressing specific challenges. So we know in South Africa, financial inclusion or financial deepening continues to be an issue. Even though we have a highly banked population, we still have many people using bank accounts as almost mailbox accounts where they withdraw their money. So could CBDC potentially be an enabler of financial and digital financial inclusion? The other is that it could support the functioning of a tokenized environment and support innovation such as smart contracts. So the idea that a CBDC, particularly a wholesale CBDC, for example, could enable this decentralized and more modular ecosystem that is composable. So you almost look at it like building money Legos in a sense. And lastly, is that multi-CBDC or this cross-border CBDC could also potentially enable, faster and cheaper cross-border payments and more direct cross-border payments between financial institutions. But the truth is that there's still tons for us to unpack in this. We also identified a number of risks that require us to unpack and look further. So, to answer it in a shorter way, is that what we're seeing is there are a number of benefits and opportunities that CBDC enables, especially around innovation, financial inclusion, but there are still quite a number of risks and policy issues we need to unpack and articulate before, for us, for example, at the Reserve Bank, we make a decision on whether or not to proceed. So I think we can unpack some of those risks a bit more detail, but let me pause there.
Thanks, Comfort. Great insights. Toby, you're a guy who's been down the crypto rabbit hole properly. I mean, I don't remember knowing you before crypto, which is why I also didn't mention anything before Block Markets Africa. How do you think about this stuff? So you understand the whole Ethereum ecosystem, the true kind of open blockchain environment where there's no restrictions on the APIs that you interact with. The ledgers are completely open. How did you find your way into where you are right now, kind of at the coalface as a consultant and development shop, building some of these solutions for industry, in the likes of Project Corker 2? Where do you see the opportunities here?
Sure, it's a couple of important questions there. I think the first thing is that we need to look at the kind of problems we're trying to solve. So blockchain technology, the way it was popularized by the Satoshi paper, etc., was on the idea of being able to provide society with tools that it's never had before to deal with societal issues. So if you go back to the idea of money, we've lived in centralized money our entire lives, and that's because we have counterparty risk. So if I have money and I need to pay Chris, and Chris don't know if I'm going to pay him, we want some central authority to be able to stand in and stand good for this and ensure that I pay Chris. So the counterparty risk drives the centralization structuring that we see in money. And this is not a bad thing. The fact that this is how we've developed it for the last 500-600 years in financial innovation is not a bad thing at all. But the challenge that we have when we're looking at blockchain technology is it's saying fundamentally there's a better way now available to us to address counterparty risk than to centralize. And there are pros and cons to centralization, and I don't think today is the forum to go into all of them, but the fundamental lookout has to be what can we do differently with decentralized technology when we come to managing counterparty risk. And what this fundamentally means is that right now, because monetary policies are all based around centralized issuance, so an entity is licensed, an entity issues money, we face challenges that are much more far-reaching in the payment and banking system than we're willing to admit, because what we see is these little pockets of fragmented systems that are trying to connect to each other. And we see all these reconciliations that's run every single day by everybody keeping a copy of their own ledger to ensure that nobody else is cheating them, right? So we have this highly sophisticated system. So Bitcoin comes out and says that we don't need any of this stuff. What we can have is a ledger that we all trust and we all agree that what's on this ledger is true. We've all verified it. And now it enables us to just have an instrument of value that we can pay with. So that instrument of value happened in the Bitcoin case to be Bitcoin, but that instrument of value could be something else. It could be a central bank issued money, like CBDC. It could be commercially bank issued money, much like tokenized deposits, which our tier one banks are exploring quite aggressively. And then it could be private money. And this is where it gets very interesting, because this is where payment service providers and merchants might actually be able to issue money, because the capacity to issue money becomes available to all on this new decentralized ledger that we all have access to. So we actually had to step out of this decentralized thinking space where crypto is saying anyone can issue currency. And when we joined the Project Corker program in early 2020, we had to learn quite a bit about centralized regulations. We had to actually put a hat on of a banker. And one of the interesting things was, and I think I can share this, is in Project Corker, the interbank wholesale stablecoin. I still recall speaking to somebody at the fintech team and saying, listen, the banks don't want to participate in this instrument because they want to have money backed by the central bank. You're asking us to build an instrument that's not backed by central bank money. And the commercial banks don't like this because they like the structure and the regulations. They like very much to operate within the paradigms of what the central bank gives them already. And this is about counterparty risk, because if you've got one commercial bank paying over to another commercial bank, no one trusts each other's money. They literally only trust the central bank's money. So that was the objective of solving a wholesale interbank stablecoin. That work has advanced quite substantially since, and I think the Standard Bank project with EZAR in Project Orca 2X actually took that quite a bit forward, and there's some exciting developments in the private sector that's followed that since. But what we're really seeing is a proliferation of money issuance. So the technology just enables new actors to issue money faster, cheaper, and, funnily enough, more transparently. So as a larger context, I think CBDCs are trying to find a way of making sense of this decentralized ledger technology, finding the role of central bank money in the context of commercial bank money existing in the space and privately issued money in the space, and defining for itself kind of a purpose. And if you ask me what that purpose would be, I'd say that it's slim pickings, to be quite honest with you. Because central bank money is a highest quality of money. It's an absolute guarantee of value, because the central bank is the actual issuer of the ultimate currency, our M0 currency. But the majority of money we use in the economy is not M0. It is not central bank money. It's commercial bank money, and there's very good reasons for that. Fractional reserve banking, as an example, drives economic development. And if we all suddenly withdrew cash from our banks, the economy would seriously suffer. So the role of central bank digital currency in a retail aspect, I think, is, even in social grants aspects, which is what we've explored in the past, is not entirely clear. Because as a social grant recipient, yeah, I want cash, but if I had digital money issued by a commercial bank, that money at least would be productive money. It would be invested in the economy. So I think central banks are probably going to pioneer really interesting things. If we look at what's happening in China, there's very interesting social applications of central bank money. And I think that there's opportunities for us to look at social relief programs for central bank money, money that expires after 7 days, as an example. These are completely new ideas that we haven't seen before. And this is where I think central banks actually have the regulatory position, the authority to experiment with entirely new examples of money. But I think it's an exciting world to be entering.
So the thing that kind of comes to my mind is we've got this, as you point out, and as we all know, it's a fragmented system that facilitates payments. But as fragmented and as chaotic it may be for an outsider looking in, it's extremely effective. We use it every day. There's very little low failure rates. I mean, all these things, it works. So we've got this Boeing that drives our economy, this liquidity that we use to make payments, and and it works. Now we're wanting to essentially switch out an engine, an important part of an engine in mid-flight. Surely to the Saab, this must be one of the big concerns as we start to explore switching out one of the engines in mid-flight. Yeah. What would you say are some of the clear risks that have kind of become obvious in the last few years to the Saab?
Yeah, so I think you've already mentioned this idea that the creation of these fragmented systems firstly develops inefficiencies, but also then could lead some operational slippages that you don't want to see. So for the Reserve Bank, I think for us, we've adopted an approach which is to embrace the innovation where we can. It's not to completely overhaul the system. So like you said, there's a lot of value in existing infrastructures. There's a lot of good infrastructure, and we're already doing a lot of work as the Reserve Bank to support further modernization, further efficiency, etc. But where there is value that is emerging within the nascent or novel business models, where we see that there is potential impact, it's really around how do we create the necessary environment for it to take place without necessarily dislodging, but also then negatively disrupting the system. So it's a very regulator answer, but it's really the sense that I don't think the outcome is that current and previous systems will be completely overhauled or removed. It's more that we would look for opportunities where new innovations can coexist with existing and ultimately be for the betterment of consumers. So from a regulatory perspective is then how do you create the necessary regulatory underpinnings and the necessary engagements with the industry to ensure that that takes place seamlessly and in a non-negatively impactful way.
It does
Sorry.
does seem to me like I'm just thinking of that earlier use case that you mentioned. Something that could be beneficial for using blockchains could be beneficial for cheaper cross-border payments, as an example. Now, I don't want to point fingers necessarily, but it doesn't seem like a technology problem per se. There are regulatory constraints that makes it difficult for us to use technologies in order to move money more seamlessly across borders. That thought popped into my head, Toby. I don't know if you've got any ideas on that.
Well, I think one of the biggest challenges we've got to look at is we've been given a tool with decentralization, and you can think of it as a very specific scalpel in a surgeon's hands. There's many, many, many other tools that's designed to solve many, many other problems. And one of my favorite things is to figure out if this is actually a problem we should be solving with blockchain. Now, one of the things that is possible with blockchain that hasn't been possible before is the ability for many different parties to issue the same money. So right now we have clearing and settlement processes because every institution issues their own money. So if we each issue our own money, then the customer who wants to pay, that customer has to have a partner, a clearing partner, that swaps their money for the money that the destination party wants. So that's a clearing and then settlement process that sits behind that. But if everybody was capable of issuing the same money, like for example in a cross-border construct, if multiple central banks could issue a Pan-African money, right, the same currency, then there wouldn't be need for clearing or settlement, because if it's the same currency, if it's the same instrument, then that can move between customers directly. There's no need to worry about a clearing process or a settlement process of collateral transfer in the back, because the instrument is the same instrument. It's fungible with itself. And this is one of the major things that I think blockchain will bring into markets. And interestingly, the markets that are most hungry for these innovations happens to be the BRICS audience. Right? It happens to be Africa. Africa, if you look at cross-border trade specifically, I mean, it's a 1-to-7 ratio in terms of how much money is brought in and out of Africa versus what Africa trades with itself. We only in Africa trade a seventh of the money amongst each other as our neighbors that we do external to the continent. And it's predominantly because Africans want dollars. And there's a need for the ability to do international payments and settlements that comes from this dollar need. It's not the dollar, it's what the dollar brings. It's that it's fungible, I can pay anywhere in the world. So we've got to look very carefully at the kind of problems we solve. Is payments going to be better because of blockchain? Well, again, only if blockchain is solving a very important underlying problem in payments. And this is like blockchain for blockchain's sake is probably the worst idea. And my favorite thing to say is that if in blockchain, right, you have thousands of servers that's doing exactly the same work over and over and over again, right? So my validator does what your validator does, what your validator does. It's a duplication of effort in an extreme degree. So you better be sure that the work that you're having everybody do is work that we all very much care about, and everything else should be done by yourself, should be done off the blockchain. So I think we need to be careful about understanding what problems we're solving, and it comes down to truly understanding what money is and how the monetary policy is being driven from a country perspective.
Yeah, I guess the thing with this technology is, like you say, is everybody needs to run a copy of the ledger and participate in the network. And so the bigger challenge probably to coming up with some kind of cross-border settlement system using this technology is, well, everybody must agree on the use case firstly. And not everybody's going to agree on the use case necessarily. And we've also seen that in South African industry with many of the different banks thinking the tech should be used for different use cases. If you can solve for that and you pick a use case, now you've all got to agree on the technology to use also. And that becomes the next difficult conversation. And so I think, there are bigger sort of governance and collaboration questions that probably need to be solved before you kind of come to the tech that helps to solve it.
100%.
I don't know if you got a comment on that, Comfort. or-
No, I think I agree with you. I think it's the use case basically determines the outcome. So if you are clear on what your objectives are and what the problem you're trying to solve is, where we're trying to steer away from is developing solutions that are looking for problems. And I think a lot of that has been said today as well by various speakers, but it's really about being clear what the outcome that you're trying to solve for is, and also taking into account existing efforts, strategies, and commitments by firstly local but also global partners to address those challenges. So we have to take into account the commitments made by the G20, for example, around the challenges of cross-border payments. What are they looking to support within that? And then where can some of these new and innovative solutions look to plug in? So I think it's really making sure that they talk to each other and they address specific and pointed and targeted problems that still exist.
Yeah. I want to move on to where CBDCs might be going. So we've kind of discussed the vision and the genesis of this idea, and how it's been difficult to come to precise use cases, and we're all still learning because it's early days for this technology. But what we've seen happening out there, outside of our sort of world, is a huge amount of innovation and also, interestingly, adoption of something like stablecoins. A stablecoin is basically a token. It's an asset that's issued on a blockchain, but it's backed by actual dollars in a bank account somewhere. And we've seen the market cap and adoption of these currencies grow quite exponentially. There are different models for it. There's a sort of more formalized, regulated type model where the stablecoin is backed by money in a bank account. So actual legal tender is backing the value of the coin. So it's really just an IOU that's circulating on a new technology. Then there's some of the innovators in the crypto space who have collateralized stable coins pegged to $1, for example, but with other assets. Some of them even backed by crypto. Some of them have been quite successful. Others obviously have failed, like that whole Terra Luna experiment, which I think set in motion the first real credit crisis in the crypto space. There are CBDCs and different models of CBDCs that have been experimented with. Toby, you've spoken about tokenized deposits as a new thing. Talk to us about tokenized deposits. What is that? Do you think that's where this might be going in the future?
I think this is where commercial banks are realizing there's an opportunity to access part of this new private money proliferation. So if you think about this, take USDC and USDT. It's $110, $120 billion of deposits between the two of them. And if you think about the platform, is tokenization, but what the function is it's private money. Because a lot of people give them dollars and they give you a unit and say, it's an IOU, you can come back to me and I'll return your deposit to you at a later stage and you can trade that IOU. It sounds very much like commercial banking if you think about it. The difference with these guys are that they don't even pretend that there's actual legal tender backing it anymore. Circle went to BlackRock and said, make me a fund, pay me 6.8% per annum, minimum subscription size $10 billion per buy, and only Circle can invest in it. So Circle is a private money issuer here that's investing in a financial product that's developed by one of the largest investment firms in the world, BlackRock, right? They're not even pretending that there's money at a bank. And this is what the commercial banks can't help but see. Because $110, $120 billion deposits, that's a decent-sized private bank, right? I mean, we're talking about a serious bank here. So tokenized deposits is an attempt, and maybe it's a strategy, by the commercial banking sector to go, I want to get some of that depositor money. So what a tokenized deposit really is just it's money that's held in some form of reserve account by the bank themselves, so money in the existing banking system, and tokens issued against that. And the challenge with that approach is that if one tier one institution, let's say a big, let's take JP Morgan Chase, who's got their Onyx platform and is their own internal stablecoin. That stablecoin is only accessible by customers of JP Morgan Chase. You can't use that to pay Citi customers, as an example. So this is where we get to the fungibility question of privately issued money. So tokenized deposits is just think of them as bank stablecoins. It's another way of just thinking about them with money actually held by the bank. But it really asks a bigger question, which is is how are we looking at this world where you've got bank stablecoins, you've got central bank stablecoins, CBDCs, and now you've got all these interesting dollar-based private stablecoins starting. And here in South Africa, I'm aware of hands don't have enough fingers to think about the number of South African rand-based stablecoins that's being launched here, right here in South Africa, to solve rand-based payment problems. And the real question that we need to be looking at is how is a proliferation of dollar-based token instruments, being commercial bank, central bank, or private money, being accessible to South Africans and Africans, actually accelerating the dollarization of our economies. So think about it as money that's just using technology to keep track of who owes what. And then think about it that there's now an easiness to issue money this way. So there's a proliferation of money. Commercial banks, there's a good 100 decent commercial banks on the continent, right? If each and every one of them issues their own local currency or dollar-based stablecoin as a tokenized deposit, clearing and settlement is going to be a nightmare. And that's just if the banks do this. You can add 2 more zeros to the private sector doing this. So you're going to have 10,000 different kinds of money in Africa in the next 2 years. And somehow we're going to have to figure out how to clear and settle between all of these kinds of money. That's actually the problem we should be putting our eyes on.
So Toby, here's where this is going. So right now, a bank deposit at bank A and a bank deposit at bank B or C, even though the counterparty risk that you face is different, which should mean that the value of that rand that you deposit, the market shouldn't value it equally. Regulation in the form of the Banks Act makes all of those bank deposits worth one, right? A rand is a rand, doesn't matter where it's deposited. What you're speaking to is a world where we've got all these different stable coins or things, you know, and they trade at different market prices. So a Tether, for example, now a privately issued stable coin will have a different market price to USDC or to TUS, that Tether Terra Luna thing that collapsed and went to naught. There's no regulatory oversight or standardization, of course, to make these things worth each other. So it means very, very chaotic, perhaps even huge amounts of risks, and consumer is obviously at risk in this type of environment. Mm-hmm. So clearly the regulator needs to be involved in standardizing the space. Comfort?
Yeah, no, absolutely. So I'm sure many of you have seen some of the work that the regulators, specifically the Intergovernmental FinTech Working Group, has been looking to develop policy positions around crypto assets. So I'm sure some of you have seen the 2021 paper, which was the regulatory position on crypto assets, and you've seen a number of instruments, or at least things being done by regulators to bring crypto assets under the regulatory ambit of South Africa. So, for example, the declaration by the Financial Sector Conduct Authority, etc. So, in that perspective, I think there is progress being made by the regulators to bring many of these within the regulatory ambit. Where I think we haven't made the most progress is around stable coins, etc. So it is an area that is starting to gain more traction. There's work being done within the crypto asset regulatory working group to look at this. And I think some of the areas that one needs to think about is obviously, you know, these assets or tokens will never be the same. There's obviously perceptions, but there's also then the operational arrangements, so the arrangements that underpin many of those innovations. So, and regulation is also then very important for that. So things around what are the stabilization mechanisms that you want to put in place, what are the reserve assets that you're requiring, I'm sorry, what are the governance and the rules that the regulators want to put in place? Are there specific verification and auditing? How do you handle the AML, CFT, and other minting processes? So I think these arrangements will play an important role, and specifically around how the regulators articulate what those arrangements should be will also be very important. So I think that's an area where we are still trying to set ourselves around that, and are beginning work and looking to publish something for the public within the coming months. I don't know the specific date, but yeah, we are working towards it.
We're going to look forward to that. Toby, I want to come back on your comment on or your explanation of tokenized deposits. So a bank has a deposit, has a ledger, money's there. Now you issue this other currency or instrument that represents that. Obviously, that now means you can make payments and value can flow. But really, the only difference there is because banks have multiple ledgers. All the banks have essentially many ledgers to keep track of assets and liabilities, often by product, and obviously rolls up into a general ledger and gets reported in the BA 900, and we kind of have an overall view of what's going on inside a bank. Is it tokenized? I don't think a tokenized deposit is really that different to just bank money. The difference, correct me if I'm wrong, is instead of now using card and the rails for card, or when you make an EFT payment, it's going through BankServe, who connects the different banks to each other. What you're speaking of is a tokenized form of money, so you're introducing a new rail, essentially. Am I understanding that right?
You absolutely are. You can always think of tokenized deposits as using a blockchain as a new clearing scheme, right? So you still need clearing participants. You still need liquidity to swap between them like you would in the normal system. The interesting thing is that the speed with which you can do these transactions, because they are automatically reconciled by all parties. It's not because the technology is faster. It's because the reconciliations are done more efficiently. That's actually the cost and speed saving. If you ever want to talk to anybody in any financial system, ask them what percentage of effort they spend on recons. Everyone knows recons is where most of the effort sits. Blockchain deals with that. It eradicates the need for the recons because it pre-recons before transaction completes. So what you're talking about here is, in essence, a clearing system that just replicates the functions we have today. Now, there are benefits for the customer. The customer might be able to have a private key, i.e. they control and own the bank money that they have for themselves in a way that if the bank server goes down, they still have their money. Like that's new benefits and behavior that we could see out of this environment. But fundamentally, that is what my personal belief about tokenized deposit is. It's not understanding the benefit of the technology environment. The technology environment actually allows us to come together and innovate how clearing and settlement works. And if we talk about this future where we have potentially thousands of private money issuers, the cost is going to be rolled up to the customer. The payment cost of being able to pay between all these mechanisms, someone has to do the integration. BankServe is going to have to integrate with 100 different payment providers if those payment providers are ultimately going to be able to participate. The idea of blockchain technology is actually to flatten the barriers to entry. And this is something that we're seeing when you talk about changing the engine mid-flight and a system that is working. It is working, but it's working for large players. It's not working for a small player that wants to enter. A small player who wants to enter the space has to work through an intermediary. They have to work through a bigger PSP. They have to work through a corresponding bank. They have to work through some other authorized entity. And the vision of blockchain-based payments is that the regulatory requirements are proactively encoded into the system. This is something that I think is going to change how we look at this, because right now, if we do look at regulatory enforcement, regulators reactively go when somebody complains and say, oh, this FSP did something wrong. Okay, we want to do an audit, do some spot checks, see if we can find it. But the blockchain technology, that smart contractability that you spoke about, Comfort, that allows us to proactively encode the regulatory requirements so that you absolutely cannot money launder with a token, so that you cannot effect a cross-border payment with a RAND instrument, so you cannot break any of the regulatory guidances put forward. And only when regulatory enforcement has been made proactive through a smart contract are we able to digest the idea of 10,000 issuers of money. Because right now, the only way to regulate is through regulating intermediaries. And there's, 20 or 30 of them, right? So you can still call them together in a room. When there's 10,000 of them, you're not going to be able to reach them all. So I think tokenized deposits is an important step that draws the industry into normalizing the space. But it's actually just replicating what we see today in the existing clearing and settlement schemes and not taking advantage of the technology's capacity in the way that we think it could.
Thanks, Toby. I think something that's been interesting to observe is all these different crypto assets and blockchain technologies, which also follows through into the CBDC space and privately issued stable coins and even closed loop industry type stable coins, tokenized deposits that you speak to, is there's no real interoperability between these different systems. What it looks like to me is that the larger crypto exchanges, who are the ones who list many of these assets, are becoming the switches. They look like they're becoming the new bank serves for this new type of technology system. There's clearly still going to be a role for these interoperability layers that connects all the different intermediaries to each other. It's complicated. I don't know how that sort of plays out, but I think there needs to be a lot more focus from industry and from regulators to think about these switching points for these new types of assets, because at the moment it's completely lacking. We've got like 5 minutes left. I'm going to ask both of you, I want to ask a question and some closing thoughts, but what is something that gets you excited about CBDCs and some of the things that you're seeing happening that gets you excited? And then if you have any other closing thoughts, please share with us, Comfort.
Yeah, for me, I think there's a lot. If most of us in the room follow CBDC, you'll know that it's an overwhelming and very complex space where every day you open LinkedIn, there's maybe 10 new publications that you need to catch up on. So it's extremely difficult to kind of find your head around, especially if you're someone that's joining it quite recently. But what's exciting about it is that there are many opportunities that CBDC may be able to open. But what I'm specifically excited about is unpacking where the opportunities are for South Africa specifically. So the more I look at it, I get the sense that CBDC is not an end in itself, right? So we need to properly and clearly articulate what the policy imperatives for South Africa are. So, for example, we have a number of awesome initiatives that the National Payment Systems Department, for example, is driving around payments modernization, RTGS renewal. We've seen PayShop is introduced, instant payments. A number of new players are also starting to play in. So if you have a number of these initiatives that are already underway, you have instant payments. Where is the value for CBDC to plug in there? So I think that's a really interesting question. The other aspect is, in a lot of conversations, we tend to be quite supply-side focused. So we focus a lot on the architecture, the deployment technologies, etc. But we don't spend enough time understanding what the consumer needs are. So getting down to understanding what are still the drivers of cash usage. So we know that perhaps there may be channel issues in townships, in the informal economy. But is there still something that people hold on to as far as holding on to a instrument that is a direct liability of the central bank? So understanding what are consumer expectations and needs around digital payments, holding on to something that is within the central bank balance sheet. So for me, it's really around taking all of the stuff that we're getting from out there, trying to crystallize it into a clear vision for South Africa. So that's the way I'm particularly excited. Yeah. And it's really around working together then with the broader ecosystem and partnering with you. No, so not designing and developing within a vacuum, but around how we engage together to design those, or at least figure those out. Yeah.
Toby?
Well, it may not be clear that I actually love CBDCs. And I don't love them because I think the instrument itself is going to be facing a lot of challenges to find its role. But what I love about CBDCs is that it requires a network to operate on. And that sets a standard for other instruments of value to be transacted on. When in Project Corker, when we were asked to build a number of the tokenizer SARB debentures, an example, when people talk about tokenizing something, they talk about the instrument as if it's something that can exist in free space. It only exists as an entry in a ledger. So what you're really talking about is putting in place an interbank ledger. And that's the first thing we did in Project Corker. And I think to date, I don't know if there's another ledger that was run by, the major institutions, the JSE, the SARB. For 2.5 years, we ran that ledger. And it was very interesting to have a book, an accounting system that was shared by major institutions. And the big insight for us was not what could major institutions do with a shared book, but what could industry do if they could participate on such a shared ledger. that is why I love CBDCs, because CBDCs will be the instrument that central banks use to lead towards the standardization of a national level ledger. And a national level ledger with regulated, proactively regulated requirements for instruments that is open for commercial banks to participate on and for private industry, and creating a new ubiquitous infrastructure for payments for a country. That, I think, is going to empower us to build solutions for the kind of complex payment problems that we're facing in tomorrow. So CBDCs to me, I think, if you gave me the personal choice, would I keep my money at my bank or as a CBDC? Of course I'd keep it in a CBDC. It's a high quality of money. But I think that's the problem. That's what will make commercial banks very nervous to support the actual rollout, because it's directly competitive to my commercial bank deposit. So yeah, I think CBDCs are going to be very, very challenging. I also think that they are forcing regulators to embrace this category from a perspective of ownership. Right, so if it's my liability I'm issuing as a central bank, I'm much more involved in the process, and I don't stand back and wait for industry to come and drop things at me. Then I have to figure out on how to regulate that. Which, I love the fact that we have a independent regulator that believes in a free market economy. But it is important that CBDCs are driving this kind of engagement from a regulatory perspective. Bottom line, I think there is really interesting applications for CBDCs in social grant space, specifically with regards to incentivizing spend in local economies, in de-urbanized areas. Things that commercial banks and private money issuers would not be able to do, but specifically things that the state has a mandate for. So yeah, on that side, I think that it's potentially going to be very valuable.
We're about to get bounced off stage. So, gentlemen, thank you. That was a very enjoyable and interesting discussion. I think with that, it brings us to the end of the CBDC panel. Thank you, everyone, for joining.
Thanks, Chris.
We'll meet outside.
Thank you very much, Chris. Thanks, everyone.
Thank you, Chris, Comfort, and Toby for a very insightful discussion. So, PIPC colleagues, there's now lunch break, and after the lunch break, there's a joint session again in the plenary room. Thanks.